Subprime loans. A subprime loan is a type of loan that is offered to individuals who have poor credit scores, typically a FICO score below 640. These loans are considered high risk for lenders due to the borrower's low credit score, which indicates a history of failing to keep up with payments or defaulting on loans. Because of this risk, subprime loans typically have higher interest rates than prime loans, which are offered to borrowers with higher credit scores. Use cases. Subprime loans can be considered by business owners who have poor credit but need funding to start or grow their business. These loans can be used for a variety of purposes, including purchasing inventory, buying equipment, or covering day-to-day expenses. Best suited for. Subprime loans are best suited for small businesses or startups with owners who have poor credit. These businesses may have difficulty securing other types of loans due to their credit history. Typical loan amounts. The loan amounts for subprime loans can vary widely, depending on the lender and the borrower's credit score, income, and other factors. However, due to the increased risk, these loans are often for smaller amounts than prime loans. Pros and cons of choosing this loan option. Pros of choosing this loan option. Access to funding for those with poor credit. Can help improve credit score if payments are made on time. May offer flexible repayment terms. Cons of choosing this loan option. Higher interest rates than prime loans. May have additional fees or penalties. Could lead to a cycle of debt if not managed properly. Qualification criteria. To qualify for a subprime loan, a business owner typically needs to have a credit score below 640. However, lenders will also look at other factors, such as income and the health of the business, when determining eligibility. Typical repayment terms. Repayment terms for subprime loans can vary depending on the lender and the specifics of the loan. However, due to the higher interest rates, these loans can be more expensive to repay over the long term. Real-world example. Let's take the example of a business owner named Tanya. Tanya has a credit score of 600 due to some past financial difficulties. However, she has a solid business plan for a retail store and needs a loan to purchase inventory. Despite her low credit score, Tanya is able to secure a subprime loan to start her business. She understands that the interest rate is higher than it would be for a prime loan, but she has a plan to make regular payments and improve her credit score over time. Important note: while subprime loans can provide necessary funding for business owners with poor credit, they should be considered a last resort due to their high interest rates and potential for leading to a cycle of debt. If you're considering a subprime loan, it's crucial to evaluate your ability to repay the loan and to explore all other financing options first. If you can, it may be more beneficial in the long term to focus on improving your credit score before seeking financing. With a higher credit score, you'll have access to a wider range of financing options with more favorable terms. Remember, the decision to take on debt should not be taken lightly, and it's important to make sure you're making the best decision for the financial health of your business. In the next lesson, we'll learn all about use cases for peer-to-peer loans. If you like this video, be sure to check out the rest of our course on building business credit at mybusinesscredit.com.